This is a company's return on tangible assets. And this metric is one of the preferred metric that Warren Buffett, the greatest investor of all time, likes to use. Stay tuned as we uncover the secrets that Warren Buffett utilizes to make good investment decisions using this metric. Incorporating Buffett's insights when it comes to the return on tangible assets can completely transform the way that you go about investing. The formula for the return on tangible assets is very simple. You take the net income and divide that number by the tangible assets of the company. The key part of the equation is the tangible assets. So tangible assets, as opposed to intangible assets, are assets that you can physically touch. Some examples of this include equipment, machinery, buildings, vehicles, stock, land, cash. Things that you can easily sell and turn into cash. Intangible assets, on the other hand, are things like trademarks, franchises, copyrights, licenses, goodwill, patents, etc. And as you can see, what they all have in common is that are things that you can't physically touch, and they're much harder to sell off and turn into cash. Now let's calculate this number together and learn why this number matters so much for Warren Buffett. And in this case, we're gonna pick one of Warren Buffett's favorite stocks, Apple. So first things first, we're gonna take the net income that is reported on the income statement and we're gonna put it right here so that we can more easily visualize the calculation. Now we need to calculate the tangible assets of the company. For this, what we could do is use the sum function, and now we can start to look at the asset side of the balance sheet. So in this case, we need to divide the things that constitute tangible assets and the things that are not tangible assets. So in this case, we have cash. So we're going to take that. Short-term investments, great. This is the same thing, so we don't want to double count. Net receivables, inventory, other current assets, this could count as well, so we're going to take it in. And then property, plant, and equipment. The things that we're not going to count are things like goodwill and intangible assets. Good thing that for Apple, the company doesn't report these. And then we're also going to take the long-term investments, and we're going to take this other non-current assets. With this all together, now we have calculated the tangible assets, and the return on tangible assets becomes very simple to calculate. So we take the net income and then we divide this by the total amount of the tangible assets. The number, as we can see right here, is roughly 28%. So what that means is for every dollar that the company owns in tangible assets, the company is generating roughly 27 cents on the dollar. As you can imagine, from Warren Buffett's perspective, what he looks for are companies that have very high return on tangible assets relative to the competition. So this actually becomes very important depending on the type of business that you invest in. So for example, if you invest in a manufacturing company, this number is going to be critical because the assets of that manufacturing company are key to generating returns for the shareholders. Here we have a list of semiconductor stocks. So basically a list of stocks in the same industry. What Warren Buffett would do, although maybe not in a spreadsheet but on his mind, is to compare this ratio with that of the competition. So let's say that we were analyzing TSM. In this case, what we're going to do is get all of these different ratios at once, and in this case we're going to be focusing on the return on tangible assets. We can see these numbers right here. For TSM, we can see that the company has a high number, and it seems to be the case that it has a high number relative to most of the companies here. So that would be a positive signal for Warren Buffett. The other thing that he emphasizes and he focuses on is the return on tangible assets relative to the debt of the equity, because the more debt a company has, the more this number can look inflated. But if the company has low debt, this number can be lower. But of course, the thing to remember, and Warren Buffett really emphasizes this, is that debt equals more risk. So the more debt a company has, the more risk there is involved in investing in that company. So it's just something for you to keep in mind. In this case, for TSM in particular, it seems that the company has a debt to equity ratio of around 0.30, which seems to be a low number compared to the competition. So that would be a green flag in Warren Buffett's book. One last reason why Warren Buffett likes the return on tangible assets is because if a company has a higher number, meaning it's more efficient than the competition, that may mean mean that the company has a competitive advantage that's allowing that to happen, and that is difficult for the other companies to replicate. So just something for you that's very important to keep in mind. As you now learn, the key is to find companies that use their assets in a smart way to create real lasting value. If you do this and the company is able to perform this consistently, it's just a matter of time before the market realizes this, the stock goes up, and you fill your pockets with real money. Now, are you inspired by Warren Buffett's investment insights? Stay tuned and subscribe to the channel so you can get notified when we release new videos like this that are gonna give you some unique investment insights that you can apply so that you can grow your wealth and portfolio over time.